Two numbers. That's what this whole video comes down to. Two numbers that completely rewire how retirement works for you. The first number kicks in while you're still saving, still grinding, still wondering if any of this actually matters. The second number hits when you're already retired, already done, already sitting on whatever pile you managed to build. Both numbers change the game entirely. Most people have never heard of either one. Financial advisors definitely won't tell you about the second one because it makes their entire industry look like what it is, a wealth transfer mechanism from your pocket to theirs. But we're getting ahead of ourselves. Here's what we're going to do. I'm going to explain exactly how these two numbers work, why they're completely different from what you've been told, and why the entire retirement industry is built around making sure you never figure this out. We're going to talk about a concept I call escape velocity. And by the end of this, you'll understand why your grandfather's retirement advice is about as useful as a flip phone at a crypto conference. Let me tell you about a guy named Marcus. Marcus is a construction supervisor in Ohio, makes about $75,000 a year, not rich, not poor, just solidly middle class in the way that used to mean something. Marcus has been putting money into his 401k for 16 years. Every paycheck, automatic contribution, company match, the whole deal. He checks his balance maybe twice a year. Last time he looked, he had somewhere around $230,000, and Marcus is frustrated. He's been at this for 16 years of packing lunches, driving the same truck, skipping the fancy vacations, and he's sitting there thinking, I've got $230,000. That's not retirement money. That's maybe I don't die in a state facility money. But here's what Marcus doesn't understand. He is literally months away from the first number, and everything changes after that. This is where I need to explain something fundamental about how money actually grows. Not the version they teach you in high school economics, which is essentially save money and good things happen. I mean the actual mathematics of wealth accumulation, which most people have never had explained to them properly. Think about a rocket leaving Earth's atmosphere. The first stage burns an enormous amount of fuel just to get a few thousand feet off the ground. Most of the energy is spent fighting gravity. The rocket barely seems to move. From the ground, it looks like nothing's happening. But once that rocket hits escape velocity, everything changes. The same amount of fuel produces dramatically different results. The rocket isn't fighting gravity anymore. It's coasting on momentum. This is exactly how compound interest works, and it's why the first number matters so much. The first number is $250,000, not $100,000, which is the number you've probably heard quoted 1,000 times. That $100,000 figure comes from a quote by Charlie Munger, Warren Buffett's business partner, delivered in 1994 to a business school class at USC. Munger said, getting to your first 100 grand is a brutal slog, and you should do whatever it takes to get there. Pack your lunch, take the bus, live like a monk. And Munger was right. In 1994, but here's what nobody mentions. In 1994, a comfortable retirement cost about $500,000. A new house averaged $154,000. A new car was $15,000. Inflation has cut the purchasing power of that $100,000 milestone by more than half. Today, that same milestone isn't $100,000. It's closer to $250,000. Now, you might be thinking, great, so the bar just got higher. Thanks, Bobby. Really inspiring stuff. But here's where it gets interesting. $250,000 isn't just an inflation-adjusted version of Munger's number. It's actually the mathematical tipping point where compound interest stops being a nice theory and starts being a co-pilot. Let me show you exactly what I mean with some real numbers. Say you're saving $12,000 a year. That's $1,000 a month, which is aggressive but doable for a lot of people watching this. You invest that money and get a 7% average annual return, which is roughly what the S&P 500 has delivered over any long period you'd care to examine. Getting to your first $100,000 takes about 7 years. And here's the painful part. Roughly 80% of that money came from your own contributions. Only 20% came from investment returns. You're the rocket burning fuel straight up, fighting gravity the whole way. It feels like you're doing all the work because you are. But here's where the math starts to get weird. Going from 100,000 to 200,000 takes about 5 more years. And in that period, your contributions drop to about 60% of the growth. Investment returns are now generating 40% of your wealth increase. The rocket is starting to tilt, gravity is losing its grip. Now watch what happens after you cross $200,000. The next 100,000 takes less than 4 years. And for the first time, investment returns are contributing more than your contributions. The rocket has hit escape velocity. You're no longer fighting gravity, you're riding momentum. This is exactly what Marcus didn't understand. He's at $230,000. He's literally months away from the point where his money starts growing faster than he can save. 16 years of grinding, and he's about to cross the threshold where the math finally starts working in his favor instead of against him. But here's the thing, nobody tells you about crossing that first number. The psychological shift is way more important than the mathematical one. There's a concept in psychology called the endowment effect. Once we feel like we own something, we value it differently. $250,000 isn't just a bigger number. It's the point where your portfolio stops feeling like a savings account and starts feeling like an asset. You stop thinking, I need to save more, and start thinking, I need to protect what I have. You start paying attention to asset allocation. You start thinking about tax efficiency. You start making decisions like someone with something to lose rather than someone with something to gain. And that shift completely changes your behavior. People who've crossed the $250,000 threshold don't just have more money. They make better decisions with the money they have. They're less likely to panic during market downturns because they've seen their portfolio survive a few. They're more likely to optimize for taxes because there's enough at stake to matter. They treat their money like a business instead of a hobby. This is why financial advisors always talk about behavioral coaching as their primary value proposition. They're not wrong. The psychology matters more than the math. But here's the catch. You don't need to pay someone 1% of your assets every year to get behavioral coaching. You just need to understand the system you're operating in. Quick aside, you know who figured this out? Drug dealers. Not the cartel types, the street level guys. There's a reason every low-level dealer talks about getting their weight up. It's not just slang, it's a recognition that scale changes everything. The same effort that moves a little bit of product at the bottom moves massive volume at the top. The drug game figured out escape velocity before physicists did. Not that I'm recommending that career path. The retirement accounts are way better in legal industries. So that's the first number, $250,000. The escape velocity threshold, the point where your money starts working harder than you do. But I promised you two numbers, and the second one is where things get really strange. The second number is $800,000, and this is the number that matters in retirement, not during the accumulation phase. This is the number that changes how you think about withdrawal rates, about risk, about whether you actually have enough to stop working. Here's the conventional wisdom. You save $1 million, you withdraw 4% a year, that gives you $40,000 in annual income, plus whatever you get from Social Security. You die with some money left over, assuming the market doesn't completely collapse during your retirement years. But here's what the conventional wisdom gets wrong. The 4% rule isn't designed to maximize your retirement. It's designed to minimize the probability that you run out of money. Those are completely different objectives. Let me introduce you to a guy named Michael Kitces. He's the financial advisor that other financial advisors go to when they have questions. He's like the Whisper network for the wealth management industry. In 2015, Kitces published a study that completely upended how we should think about retirement withdrawals. He looked at every rolling 30-year period going back to the 1870s, over 115 different scenarios, and what he found was remarkable. In over half of those scenarios, retirees following the 4% rule ended up with more than double their starting principal. Let me say that differently. If you retired with $800,000 and withdrew 4% annually, there's a 50% chance you'd die with more than $1.6 million. And here's the part that sounds insane. There's a 50% chance you die with more than triple your starting amount, $2.4 million from an $800,000 start. Now, you might be thinking, okay, but what about the downside? What about running out of money? And this is where it gets really interesting. Out of those 115 scenarios, only 12 ended with less than the starting principal, and zero. Zero ended with a portfolio completely depleted. Zero. The 4% rule was designed by a financial planner named William Bengen in 1994. He wanted to find a withdrawal rate that would have survived the worst retirement period in modern history, which turned out to be someone retiring in 1968, right before the stagflation of the 70s. 4% worked. It got you through the worst case scenario. But here's what nobody mentions. The worst case scenario is not the typical scenario. It's the outlier. Bengen himself has since updated his research. He now says the safe withdrawal rate is closer to 4.7%, maybe even 5% in certain conditions. And Kitces' research suggests that the average safe withdrawal rate across all those historical periods was 6%. 6%, not 4. Now let's do some math with our second number. $800,000 at 4% withdrawal gives you $32,000 a year. Add Social Security. The average benefit right now is about $1,900 per month per person. For a married couple, that's $45,000 a year. 32,000 from your portfolio plus 45,000 from Social Security equals $77,000 in annual income. But here's the key detail. That $77,000 is taxed very differently than $77,000 in wages. Social Security benefits are partially tax-free, and depending on how you've structured your retirement accounts, your withdrawals might be taxed at very low rates too. If most of your retirement income comes from Roth accounts, you might pay almost nothing in federal taxes. If it comes from traditional 401k accounts, you're still probably in a lower tax bracket than you were during your working years. This is where the $800,000 number really matters. At that level, your portfolio is generating enough income that, combined with Social Security, you can replace a substantial portion of your working income. Not all of it, but enough that the difference isn't life-changing. And that's the threshold where retirement stops feeling like a scary unknown and starts feeling like a reasonable transition. But there's a psychological problem here that the math doesn't solve, and it's the reason most retirees end up with way more money than they need. Let me tell you about a woman named Patricia. Patricia spent 32 years as a school administrator in Texas, retired at 63 with $860,000 in her retirement accounts. Solid pension, decent Social Security benefit. Patricia had done everything right. Her financial advisor told her she could safely withdraw 4% a year, which would give her about $34,000 from her portfolio. Add her pension and Social Security, and she'd be at about $70,000 in annual income. But Patricia couldn't do it. Every month when her statement arrived, she'd look at the balance, and if it had gone down even slightly, she'd panic. She started withdrawing less than the 4%, 2%, sometimes less. She lived on her pension and Social Security alone, barely touching her portfolio. Her lifestyle suffered. She stopped traveling. She stopped going out to dinner. She told her kids she couldn't afford to help with the grandkids' college funds. 5 years into retirement, her portfolio had grown to over $1 million. She was so afraid of running out of money that she was accumulating wealth during retirement. She had become her own worst enemy. And she's not unusual. Studies consistently show that retirees underspend relative to what their retirement plans would safely allow. The fear of running out trumps the reality of having more than enough. This is the psychological trap of the $800,000 threshold. It's the point where you have enough that rational withdrawal strategies would almost certainly leave you with more money than you started with. But it's also the point where the fear of loss becomes paralyzing because there's finally enough to lose. Let me tell you another story. There's a concept in aviation called the death zone on Mount Everest. Above 26,000 feet, there's not enough oxygen to sustain human life for more than a few days. You're technically dying the entire time you're up there. Climbers have to move fast, make decisions quickly, and get back down before their bodies shut down. The death zone creates a psychological state where otherwise rational people make terrible decisions. They keep pushing for the summit even when their oxygen is running low. They pass struggling climbers without stopping to help. The environment itself warps their judgment. Retirement has its own death zone. It's the period right after you stop working, when the paycheck stops and the withdrawals start. Every dollar that leaves your portfolio feels like a step closer to the edge. The fear of running out creates the same psychological distortion as lack of oxygen. You make decisions that don't make mathematical sense because your brain is screaming that you're dying even when you're not. The $800,000 threshold is significant because it's the point where the math says you're almost certainly going to be fine, but the psychology says you're definitely going to be scared. And the financial industry knows this. They know that fear is more profitable than comfort. A scared retiree keeps their money in conservative investments that generate fees. A scared retiree hires advisors they don't need. A scared retiree is a reliable revenue stream. Quick aside, the financial industry is the only business where fear and complacency are equally profitable. Afraid? Buy our insurance products. Comfortable? Let us manage your wealth. Uncertain? Here's a consultation. The house always wins because they've monetized every emotional state you could possibly have about money. Now here's where everything comes together. You've got these two numbers, $250,000 during accumulation, $800,000 during decumulation. But the real insight isn't about the numbers themselves, it's about what they represent. The first number is about escape velocity. It's the threshold where your money starts growing faster than you can save, where compound interest transitions from a theoretical benefit to a practical reality, where you stop feeling like a saver and start feeling like an investor. The second number is about psychological security. It's the threshold where the math almost guarantees you'll have more money than you started with if you follow a rational withdrawal strategy, where the fear of running out is objectively unwarranted, where you can stop worrying and start living. But there's a problem with both numbers. They're completely useless if you don't understand the system they operate in. Let me tell you about a conversation I had with an accountant about 6 years ago. I was asking him about retirement planning, and he said something I'll never forget. He said, "Bobby, the tax code isn't designed to help you retire. It's designed to help the government finance its operations. Every deduction, every credit, every rule exists because someone lobbied for it. If you're not thinking about taxes as a system, you're thinking about them wrong." And he's right. The retirement system in America is built on a series of incentives that mostly benefit people who already have money. The 401k system lets you defer taxes on contributions, but it's most valuable if you're in a high tax bracket during your working years and a lower one in retirement. If you're already in a low bracket, the benefit is minimal. The Roth system lets you pay taxes now and withdraw tax-free later, but that only helps if you expect your taxes to be higher in retirement, which is rare for most people. The point is that understanding the system matters more than hitting any specific number. The $250,000 threshold is where compound interest becomes your ally instead of your enemy. But if you're paying unnecessary taxes on your investment gains, you're bleeding efficiency at exactly the moment when efficiency matters most. The $800,000 threshold is where withdrawal strategies become mathematically favorable. But if you haven't structured your accounts to minimize taxes on those withdrawals, you're leaving money on the table every single year. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Let me give you a concrete example of how this works in practice. I mentioned Marcus earlier. Let's say Marcus crosses the $250,000 threshold next year. He's 47 years old, he's got 18 years until traditional retirement age. Here's what happens if he stays on his current path. At $250,000, earning 7% annually, his portfolio doubles to $500,000 in about 10 years without him contributing another dollar. But Marcus keeps contributing. Let's say he can bump up his savings to $15,000 a year now that his kids are out of daycare. In those same 10 years, with contributions and growth, he'd hit about $750,000. Another 5 years gets him past $1 million. By the time he's 65, he's looking at $1.3 million or more. Now let's talk about the withdrawal phase. Marcus will have Social Security. Let's assume he and his wife together get about $40,000 a year, which is conservative. At $1.3 million, a 4% withdrawal gives him $52,000 annually. Total income, $92,000. But here's where the system matters. If Marcus has structured his accounts right, with some money in Roth accounts and some in traditional accounts, he can manage his tax exposure. He might pay federal taxes on only $70,000 of income after deductions and exemptions. His effective tax rate could be under 10%. This is what it looks like when the numbers work. But here's the thing. Most people will never hear this explanation. They'll get pieces of it from different sources, usually with some agenda attached. Their employer's 401k advisor will tell them to save more, but won't explain why the investment options in their plan have expense ratios that would make a hedge fund blush. Their tax preparer will file their return, but won't mention that Roth conversions might save them tens of thousands of dollars over their lifetime. Their bank will offer them a retirement account, but won't explain that the fees they're charging will eat up years of compound growth. Quick aside, I once had a banker try to sell me a certificate of deposit paying 0.5% interest while inflation was running at 2.5%. He kept saying, "It's guaranteed." I said, "Guaranteed to lose purchasing power. Yes, I can read." He was not pleased. We did not do business. So let me give you 3 practical takeaways from everything we've covered. First, ignore the $100,000 milestone. It's outdated by 30 years and it's holding you back. The real threshold is $250,000. And the reason it matters is psychological as much as mathematical. Every month you're below that threshold, you're in the grind phase. You're burning fuel fighting gravity. That's normal. That's expected. Don't get discouraged by the slow progress. You're literally months away from escape velocity, even if it doesn't feel like it. Second, stop optimizing for the worst case scenario. The 4% rule is designed for the worst retirement timing in modern history. Unless you're extremely risk-averse, you can probably withdraw more. Kitces' research shows the average safe withdrawal rate is closer to 5%. That's 25% more income every year. Over a 30-year retirement, we're talking about hundreds of thousands of dollars in additional spending power. The fear of running out is causing retirees to leave massive amounts of enjoyment on the table. Third, understand the system or hire someone who does. The tax code, the retirement account rules, the Social Security claiming strategies, All of it forms a system that rewards knowledge and punishes ignorance. You don't need to become an expert, but you do need to recognize that the default option is usually the one that generates the most fees for someone else. The $250,000 threshold is where optimization starts to matter. The $800,000 threshold is where optimization pays for itself many times over. Here's the thing, nobody wants to admit about retirement planning. The people who do it well aren't smarter than you. They're not luckier than you. They just understand the system better than you. They know that compound interest is a force multiplier after escape velocity. They know that withdrawal rates are tools, not laws. They know that fear is more expensive than taxes. Lazy investing built more fortune than crypto memes. But lazy planning will cost you more than any market crash ever could. The two numbers matter. $250,000 changes how your money grows. $800,000 changes how your money flows. But the number that matters most is the one you can't calculate. It's the day you stop being afraid of your money and start using it for what it's actually for, buying freedom. Everything else is just accounting.